Hello and welcome to SWOG Academy. In this video, I will make an in-depth stock fundamental analysis of the company Celsius Holdings. I will cover its business model, growth and revenue, profitability, balance sheet, valuation, and finally do the 3M analysis. So make sure to watch till the end of the video. Celsius Holdings was founded in 2004 by Steve Haley. Its headquarters is in Boca Raton, United States. Celsius has 913 employees worldwide. The company has a $13.4 billion market cap. Its stock is trading around $57 at the time I'm making this video. Celsius Holdings Inc. is a global beverage company and maker of premium lifestyle energy drink, zero sugar alternative to traditional energy drinks. The company also makes protein bars. Celsius grew its revenue from $15 million in 2014 to $1.3 billion in 2023, an 87x return in 10 years, resulting in 56% compound annual growth rate. Very impressive results. The majority of the revenue comes from North America. A very small portion comes from Europe and Asia Pacific, which means Celsius still have a huge room for growth. The main customers of Celsius are PepsiCo and Costco. Around 70% of the revenue comes from both customers. 30% of the revenue is made with other customers. I personally do not like to see such a high concentration. If a problem occurs with Pepsi, Celsius will lose a big part of the revenue. Celsius is planning to expand globally. In Canada, the sales began in January 2024. In the UK in April 2024. In Australia, New Zealand and France at the end of the year. Celsius is gaining market share. As you can see, the black line is growing and so is Celsius market share. Whereas the market for Red Bull, the red line, is declining and so is the market for Monster energy drink. As you can see in the chart, the energy drinks household penetration is growing, and so is the energy beverage market. However, the total beverage market is declining by around 3.5% every year, so more households are buying energy drinks more often. Now let's check the profitability of the company. The gross profit is the result of revenue minus the direct costs to create these revenues. The gross profit margin is the result of gross profit divided by the revenue. The gross profit margin shows the amount of profit made before deducting selling, general and administrative cost. The gray line in the chart represents the gross profit margin over the years. Celsius gross profit margin in 2023 is 48%. This is very good for a beverage company. It is also clear that the gross profit margin is increasing with revenue, which is something I really like to see. This means that the company is getting more efficient and have a good operating leverage. Next, let's check the operating profit and the operating profit margin. Operating profit is the net income derived from a company's core operations. It is the amount of money that a company has left over after meeting its operating cost but before paying its taxes. Celsius made $266 million operating profit in 2023. However, the company have been losing money since 2014. 2023 and 2020 are the only years the company was positive. So how did the company finance itself? Well, by issuing shares and selling them. I will cover this later in the video. The same can be seen with the free cash flow. The company has been losing money and cash. However, the numbers improved in 2022 and 2023. This is, however, normal for such a company since they have to invest in their growth and operation. I will cover this later in the video. Now let's check the efficiency of the company. In other words, analyze the operating cost. Celsius operating expenses were $367 million in 2023. The operating costs have decreased with the revenue increase, which shows that the company is operating efficiently. Now let's have a quick look at Celsius' balance sheet. Celsius has $1.3 billion in current assets. The current assets are the assets that are liquid and available to the company within 1 year. They include cash and short-term investments. The total current liabilities are the liabilities which the company must pay within 1 year. Celsius' total current liabilities are $315 million. Celsius' total liabilities, including long-term debt, are $483 million. By calculating the current assets minus the current liabilities, Celsius is left with $1 billion cash on its balance sheet, making the balance sheet extremely strong and healthy. Celsius can use this money to buy back stocks, invest in the company, or to buy another company. Now let's jump to valuations. Celsius has a 9.66 price to sales ratio, a 63.46 PE ratio, a 49.55 price to free cash flow ratio, and a 39.65 price to book ratio. Pause the video and check how the current ratios compare to previous years. Yes, the valuation looks expensive. However, Celsius is a high growth stock. A 63 PE is okay for such growth, not cheap, but okay. Now let's do a discounted cash flow analysis to determine the fair price and intrinsic value of the stock. This is how my model works. I calculate the worst case scenario to determine the downside, a normal case and best case scenario. The first column represents the growth rate for the next 5 years. The second column represents the growth rate for the 5 years afterward. The third column represents the terminal multiple or the PE multiple at which the stock will be sold in 10 years. The fourth column represents the discount rate or the rate of return the stock will grow over the years. Considering a 30% growth the first 5 years, a 25% the 5 years afterward, a terminal multiple of 23 and 15% discount rate, the intrinsic value of the stock is $50.06. Celsius is trading at $57 currently, which is higher than the intrinsic value. Finally, the 3M analysis, 1M for moat, 1 for management, and 1 for margin of safety. Celsius does not have a moat. Yes, it is a good brand, but it is not Coca-Cola, which means other companies might penetrate the market, which will lead to Celsius losing market share. Management did a good job growing the company over the years. However, since Celsius was losing money in the last years, management issued shares to finance the company. As you can see, the number of shares grew from 61 million to 237 million. This is diluting the earnings for us investors. Now that Celsius is profitable, let's hope management stop issuing shares to finance the company. For the margin of safety, Celsius is trading at a premium price well above the intrinsic value. The balance sheet is strong, so there is no risk of Celsius being bankrupt. In conclusion, Celsius is a good company with a great future and a lot of growth. Revenue is increasing rapidly, the company is free cash flow and operating profit positive. However, the company does not have a moat. The stock is expensive and management is diluting shares. Will I buy the stock? Yes, at the right price. If the price reaches $40 in the future, I will buy the stock. I hope you found value in this video. If yes, please give us a like. This helps a lot and consider subscribing. Thank you very much for watching.